Countries around the world are drowning in debt because governments have been borrowing to support their economies. Global debt levels are higher now than they have ever been, and there's no signs of them slowing down. Today, we'll reveal which countries are struggling to keep up with their debts, how they plan to tackle their massive deficits, and what this means for the global economy. What is debt actually made up of? Well, to keep things simple, national debt is made up of three components: corporate debt, household debt, and government debt. Corporate debt refers to when a company borrows money either from banks, investors, or institutions in order to help grow its business. This money can come in the form of bonds, loans, or commercial papers, and is usually used to expand the business, pay bills, and invest into the future of the company. Obviously, the pandemic created unforeseen problems, and many companies ended up borrowing money just to keep the lights on. This debt was issued at record low interest rates, thanks to the actions of the Federal Reserve and other central banks. For many, this served as a much-needed lifeline. Others, however, saw this as an opportunity to take out massive loans that they otherwise couldn't afford. The problem is, interest rates didn't stay down for long. Pretty soon, the Fed turned off the money printer and started hiking up interest rates in a big way. In fact, at the time of shooting, interest rates in the United States are at 5.5%, a level the US hasn't seen since 2001. Many companies are only now able to pay back the interest on those loans without being able to grow. These are dubbed zombie companies, which only exist because of the money they've borrowed. For many zombie companies, things have gotten so expensive that they've gone bust over the last 2 years. And by the way, if you're enjoying the video so far, smash that like button to give it a boost, punch that subscribe button, and slap that notification bell so you don't miss our next one. Now, moving on. Household debt is a term that includes both consumer debt and mortgages. Basically, it combines the consumer debt total of each individual living within a household, plus the mortgage costs. Consumer debt includes day-to-day borrowing such as credit card debt, student loans, auto loans, personal loans, payday loans, etc. But by far the biggest contributor to national debt is government debt, which refers to the amount of money borrowed by a government to fund its expenses, development projects, and budget deficits. Now, governments raise this money by issuing bonds and selling them to investors with a guarantee that they'll be paid back with interest. Government debt is typically measured by economists against a country's gross domestic product, or GDP. If a country's debt to GDP is above 100%, then this means that it owes more money than it's pulling in through taxes or sales of bonds and such. So then, which countries have the highest debt to GDP levels around the world? Let's take a look. So, in 5th place on the government debt leaderboard is France, with around $3 trillion of government debt, about 110% of GDP. Meanwhile, France's household debt is 71% of GDP, and corporate debt is around 91% of GDP, according to the European Commission. Now, France's economy has struggled for decades and hasn't had a balanced budget since 1973. This is a problem that's been noticed around the world, and it's deterred foreign investment, making it harder for France to grow its economy. To try and repay those debts, the French government has been taxing its citizens to death. In fact, France has some of the highest taxes of any country in the world. This too has made it harder for its economy to grow, which has only increased government debts further. It's funny how that happens, isn't it? But why is France in so much debt to begin with? Well, there are various historical reasons, including wars, social welfare spending, and the demographic challenges of an aging population with a low birth rate. Additionally, the sheer size of the French state and its industrial policies are financially burdensome. France also uses the euro, the world's second reserve currency. Typically, institutions treat the euro and euro-denominated bonds as safe investments. Now, because Germany, the Eurozone's other big country, doesn't really issue all that much debt, this has created an artificially high demand for French debt, making it possible to borrow more. The result is that between 2008 and 2018, France was under the EU's excessive deficit procedure, and more recently, it was downgraded by both S&P and Fitch from AA to AA-, rating it on a par with Czechia and Slovenia. But despite all of this, some economists argue that there's not actually much to be concerned about. Interest rates have started coming down, and inflation has helped to steady the debt to GDP curve. And to be fair, France's economy rating of AA- is still pretty good. In fact, there's even a bit of optimism in the air. That's because France plans to address stagnant economic growth by investing into long-term infrastructure. This includes money for training up young people, improving hospitals and healthcare systems, and reforming government spending. There's also a focus on green investments such as building sustainable transport and decarbonizing the industrial sector, along with investments into things like improving broadband, cybersecurity, quantum computing, and cloud services. It's safe to say, though, that not all of these initiatives will be effective in boosting France's economy. However, this all depends on how President Emmanuel Macron manages government spending. Macron's reputation for competence has taken a hit due to his inability to balance the books, but hey, let's not go there. Okay, in fourth place on the government debt leaderboard is the United States, which currently has over $35 trillion of debt, which is 123% of its GDP. Ouch. As a not-so-fun fact, that works out as an average of over $100,000 per American. Meanwhile, household debt accounts for 74% of GDP and corporate debt for 78% of GDP. In terms of where this government debt comes from, there are three sources. The first is demographics. The US, like France, has an aging population, and this means more money is being spent on entitlements like pensions. This ties into the second reason, rising healthcare costs. In the US, average healthcare cost per person is double that of any other country, and it's generally agreed that Americans don't exactly get what they pay for. However, there's one major outlier that has contributed to government debt, and that's consistent overspending and insufficient taxing. For context, in 2023 alone, the US brought in $4.4 trillion in revenue, but spent $6.1 trillion. The remaining $1.7 trillion had to be borrowed, more for the debt pile. And if that wasn't concerning enough, then take a second to consider that the interest on this debt is growing at an alarming rate to the tune of $2.4 billion per day. As of March last year, servicing this debt accounted for as much as 12% of federal spending. It's no wonder then that 84% of voters in the US want debt to be a government priority. This is a bipartisan concern, but unfortunately, there's no easy way to make cuts and increase revenue without negatively affecting US citizens. Now, logically, politicians have put forward plans to cut government spending and increase taxes to rebalance the books, but many of these plans include cutting spending on entitlement programs, while raising taxes would adversely affect the markets, which could reduce overall tax revenue. But wait, there's more. At the same time, there's no desire to cut back on the US government's excessive military spending given increased geopolitical tensions. In fact, politicians from both sides of the aisle have long had a habit of borrowing money to expand federal spending on financing wars, tax cuts, healthcare, and emergency measures such as recessions. However, this debt can have serious consequences. The point is that if the US defaults even for a moment, global investors will look for alternatives. This would only make the deficit even worse, which would slow down the economy further. Never mind the fact that US government debt is the primary form of collateral for the entire financial system. Okay, in third place on the global debt leaderboard is Italy. With around $3.1 trillion of debt, Italy's debt to GDP ratio is 139%. Notably, Italy's debt has been running above 100% of GDP since the 1990s. Meanwhile, Italy's household debt sits at 41% of its GDP, while corporate debt accounts for 68%. Historically, Italy's economy has seen a few setbacks. For one thing, Italy has always had a massive tax evasion problem, which is estimated to be costing around 100 billion euros in tax revenue per year. Back in the 1970s, Italy was affected by the global oil crisis at a time when inflation was already running high and employment levels were relatively low. As a result, the Italian government had a budget deficit of around 10% of GDP, the highest of any industrialized country in the world. Because of this, the lira, the Italian currency at the time, lost around 70% of its value in just 10 years, a big red flag for foreign investors. This contributed to Italy's GDP slowing down for the next 5 years before it exploded to the upside. This explosion wasn't small either. By 1992, Italy had tripled its economic output. How did Italy manage this? Well, first, it tackled inflation in a big way. For context, in 1980, inflation was at 20.6%. Just 7 years later, it had fallen to 4.7%. Italy then started producing high-quality materials used in some of the world's leading brands, everything from Gucci handbags to the seats inside a Ferrari. Italy became a byword for quality and craftsmanship. However, things took a turn for the worse in the 1990s as the government began to lower taxes and increase fiscal spending, which resulted in, you guessed it, more government debt. The thing is, while it might be on our leaderboard, Italy's economy has proven to be quite resilient and appears to be on the cusp of another boom. Whenever it's taken a dip, the subsequent recovery has been nothing short of staggering. As you can hopefully see from this chart, things have been turning around since 2020, following the pandemic. In fact, Italy's post-pandemic recovery has seen more growth than France, Germany, and the UK combined. If we see history play out again, then we could see Italy's debt-to-GDP ratio fall off a cliff. Prime Minister Giorgia Meloni, who came into power in October 2022, now has the difficult task of getting Italy's economy back on track, and plans to cut taxes and increase spending in the hopes that this will revive the economy. Well, let's see how she gets on. Now in second place is Singapore, which has around $850 billion of debt. This may be less than France, the US, and Italy in terms of dollar value, but it works out to 162% of its GDP. Meanwhile, Singapore's household debt is 48% of GDP, and corporate debt is 131% of GDP. Now, Singapore is an interesting case study because apparently its debt level is misunderstood. According to the government's website, quote, "The Singapore government has no net debt. We have a strong balance sheet with assets in excess of liabilities." Well, okie dokie then. In all seriousness though, they're not wrong. The Singaporean government has been issuing debt to be invested as part of its reserves, which cannot be spent, and have only spent money on qualifying infrastructure projects that provide Singapore with real economic value. The assets being invested into include cash, shares, and bonds, and as such, Singapore's economy is actually quite strong despite its high debt-to-GDP levels. Indeed, Singapore serves as a reminder to economists that a country's debt levels can't simply be judged based on the debt-to-GDP ratio alone. In fact, Singapore's economy is often ranked as one of the best in the world, one of the least corrupt, and one of the most pro-business. Singaporean residents also have the enjoyment of low taxes and have the second highest GDP levels per capita. It's impressive stuff. But hold on a moment. If residents don't have to pay massive amounts of tax, then how is the government funding this asset investment? Well, Singapore's sovereign wealth fund, Temasek Holdings, owns majority stakes in the nation's largest companies, which helps them to bring in even more revenue. And not only this, but Singapore's location makes it a hub for international trade and finance with proximity to major markets, particularly in Asia. And with a business-friendly environment and a well-diversified economy featuring a mix of all sorts of industries, there's no shortage of pies for Singapore's government to dip its fingers into. Right then, it's time for the winner. or loser, depending on your perspective. So, at the top of our government debt leaderboard with a staggering $4.5 trillion of debt is Japan. That works out at a government debt to GDP ratio of 254%. Yes, you did hear that correctly. Meanwhile, household debt is 68% of GDP, and corporate debt is a problem of its own, sitting at 118% of GDP. And as much as 43% of Japan's government debt is held by the Bank of Japan. Now, Japan's economy has been stagnant for decades, with sluggish GDP for almost 30 years. But why is this? Well, Japan suffered a massive financial crisis in the 1990s, known as the Lost Decades. From the 1950s, shortly after World War II, Japan experienced 3 decades of rapid growth, transforming it into the world's second largest economy. This growth was driven by exporting advanced technologies like cars, electronics, and consumer goods of higher quality and lower prices than competitors. The US became concerned about Japan's influence as Japan bought up lots of American businesses with a seemingly endless cash supply. By the 1980s, Japan was surpassing the US in many categories that it used to dominate. However, Japan's cash supplies weren't endless. Its largest companies had formed an alliance supported by the government, holding shares in each other and receiving massive loans, creating an artificially inflated economy. The bubble burst in the 1990s, revealing many zombie companies that would otherwise have gone bankrupt. This ended 3 decades of rapid growth and kick-started 3 decades of stagnation, those so-called lost decades. Japan has never fully recovered, and the reasons for this remain unclear. A popular theory is that households and companies had simply taken on too much debt as asset prices rose. When asset prices came crashing down, focus shifted onto paying off debts rather than taking more debts on. In fact, the Bank of Japan even tried to cut inflation rates to encourage spending, but it didn't work. And as this crisis has endured, the risk of deflation has increased. For reference, deflation is supposedly worse than inflation because it creates a downward spiral by discouraging borrowing. To prevent this, the BOJ found ways to pump money into the economy and keep prices up by buying loads of corporate and government bonds. In other words, quantitative easing. And as a fun fact, Japan has done more quantitative easing than any other country in the world, hence in large part why its debt to GDP ratio is so damn high. Between 2016 and 2023, the BOJ even began yield curve control measures by buying enough debt to keep government borrowing costs below a certain level, because any increase in debt servicing costs would add billions to the debt. The only problem is, this isn't sustainable. At some point, the yen will lose too much of its value because of all the de facto money printing. Some would say this is already happening as the yen has lost almost 50% of its value against the US dollar over the last few years. At some point, the BOJ will have to start raising rates to save the yen, and it looks like it has recently been making moves in that direction. Well, folks, there you have it, the top 5 most indebted countries out there, collectively sitting on liabilities large enough to block out the sun. Such massive debts are a problem that can't easily be solved, so we can probably expect to see them continue to pile up as time goes on. Let's just hope that emerging technologies such as AI and quantum computing offer a way out of this debt trap the world has fallen into, because the alternatives won't be much fun. Okay, that just about wraps up today's video, but what did you think? Do you live in any of the countries that made it onto today's debt leaderboard? Let us know in the comments. We'd love to hear from you. And while you're down there, don't forget to smash those like, subscribe, and notification buttons to get our next video on your radar as soon as it's released. And if you know someone who would love this sort of content, then take a second to share it with them. Thank you all so much for watching, and we will see you next time.